There are many classical debates in the world of investing. A popular one is concentration versus diversification. A concentrated portfolio has just a handful of stocks. If these stocks are picked well, they can help amplify the overall returns. But the opposite is also true. Such a portfolio can be quite risky, as the adverse move in just a few stocks can severely damage it. On the other hand is the diversified portfolio with many stocks. Such a portfolio is deemed to be comparatively safer but less rewarding. Now, in the case of mutual funds, we have both variants. There are focused funds mandated to invest in a maximum of 30 stocks, and there are normal equity funds with no such restrictions. So they tend to have more stocks. So which is the better option? Do focused funds really do better on returns but at a higher volatility? Are diversified funds really safer but less rewarding? Well, we will find the answer in this video. Hello and welcome to ET Money's YouTube channel. Today we will compare focused and diversified equity funds. Now this video belongs to our fund categories playlist. For more analysis on categories, check out our other videos. Okay, let's begin with a quick introduction to focused funds and the suitable type of diversified funds to compare them. As I mentioned earlier, focused funds are mandated to invest in a maximum of 30 stocks. But that's not the only requirement. A focused fund also needs to mention the market cap segment it intends to target: large, mid, small or multi. Now, as of November 22nd, 2024, there were 28 focused funds available. 25 have a mandated multi-cap orientation. That is, they can invest in large, mid and small caps. Just 3 funds, Quant Focused, Motilal Oswal Focused and LIC Mutual Fund Focused, have a mandated large cap orientation. So 80% of their corpus will always be invested in large cap stocks. Now another important thing is that a multi-cap orientation does not mean the funds must invest like multi-cap funds. That is, allocate at least 25% each to large, mid and small caps. It means that the fund is free to invest across all market caps in any proportion. And that's what makes almost all focused funds similar to flexi-cap funds. Both categories can invest anywhere and in any proportion. The only difference is that focused funds have a restriction on the number of stocks while flexi-cap funds don't. So our natural choice for diversified equity funds will be flexi-cap funds. Now on your screen is the comparison of some basic details of focused funds and flexi-cap funds. The focused category has 28 funds as against the flexi-cap's 39. The average number of stocks in the focused category is 27 while the flexi-cap category is 64. That's more than twice. Now the focused funds AUM of about 1.47 lakh crore is just over a third of FlexiCap's 4.27 lakh crore. The biggest focused fund is the SBI Focused Fund, which has about 35,000 crores of assets. And with assets of about 82,000 crores, the biggest FlexiCap fund is Parag Parekh FlexiCap Fund. Now the top 5 focused funds command over 85,000 crore in AUM compared to FlexiCap Fund's 2.46 lakh crore. So, while the focused category has a decent size, it still dwarfs in comparison to flexi-cap funds. Okay, let's compare the returns of the two categories now. Now, as per the hypothesis, focused funds should be more rewarding than flexi-cap funds thanks to their concentrated portfolio. We will use 3 return metrics here: trailing returns, calendar year returns and rolling returns. First, let's check the trailing returns of the two categories and the Nifty 500. Now in terms of trailing returns, both categories have stayed ahead of the Nifty 500 across 1, 3 and 5 year time frames. Focused funds have outperformed flexi-cap funds over the last year, but they have fallen behind over the last 3 and 5 years. Let's next compare the two categories in terms of the calendar year returns. Of the 7 calendar years since 2018, focused funds did better than flexi-cap funds and the Nifty 500 in just 2, 2019 and 2024. They did better than flexi-cap funds in 3, 2019, 2022 and 2024. On the other hand, flexi-cap funds did better than both focused and the Nifty 50 in 3 years, 2020, 2021 and 2023. Now flexi-cap funds did better than the focused funds in 4 years, 2018, 2020, 2021 and 2023. So focused funds don't seem to have a clear edge even in terms of calendar year returns. Lastly, let's check the average 3-year rolling returns of the two categories. Now these are obtained by averaging all 3-year returns between two specific dates. So rolling returns give a more reliable picture than trailing returns. But why 3 years? Well, since the fund recategorization happened in 2018, considering 3-year rolling returns will give us sufficient data points to draw an inference. Now in terms of average 3-year rolling returns, focus funds do better than both FlexiCap funds and the Nifty 500. They have delivered about 17% per annum as against FlexiCap funds 16.3% and Nifty 500's 14.5%. Overall, while trailing returns and annual returns didn't paint an exciting picture of focus funds, these funds regained their lost ground in terms of rolling returns. But the other side of the equation, risk, also needs to be checked. Now, hypothetically, focus funds should be more volatile than FlexiCap funds. But before we get into that, a small request. If you are finding this video useful and would like to watch more such videos, do subscribe to our channel and don't forget to press the bell icon so you never miss a video from us. We will compare two metrics, downside protection and volatility as measured by standard deviation. Let's start with downside protection. Now to find that out, we check the performance of focused and FlexiCap funds in the quarters when Nifty 500 gave negative returns. Across the 8 quarters in January 2018 in which the Nifty 500 gave negative returns, focused funds did better than both FlexiCap funds and Nifty 500 in just 2 quarters. They did better than FlexiCap funds in 3 quarters. Now FlexiCap funds did better than focused funds and the Nifty 500 in 4 quarters. They did better than focused funds in 5. So the more volatility nature of focused funds is visible here. Let's also check the volatility as measured by standard deviation of the 3-year rolling returns. The higher the standard deviation, the higher the volatility. Surprisingly, focused funds have proved to be less volatile than both FlexiCap funds and the Nifty 500. So they have not only delivered better 3-year rolling returns but have also done so at a lower volatility. Now, what explains the good overall performance of focused funds over the medium term but comparatively riskier nature in the short term? Let's try to figure it out in the next section. Let's take a look at the market cap allocations of the two categories. Over the last 5 years, as seen through October end portfolios, focused funds have reduced their large cap exposure and increased their mid cap allocation. Their large cap exposure has dipped from 67% to 58% and the mid cap exposure increased from 15% to 20%. This possibly lent their portfolios volatility in the short term but improved their performance in the medium term. FlexiCap funds have also cut their large cap exposure but less deeply from 68% to 63%. But their mid cap exposure has decreased too from 18% to 15%. This may have impacted their performance at a time when mid-caps have done very well. Now, what explains the better volatility management of focused funds versus FlexiCap funds in the medium term? Now, there could be two possible explanations for this. First, the average cash position of focused funds stands at 11% as against FlexiCap funds 9%. And second, their average small cap exposure is also lower at 8% against the FlexiCap funds 10%. So, it appears that focus funds have prudently managed risk return by reducing their large cap allocation, betting more on mid caps than small caps, and keeping a higher cash allocation. So, does it mean that focused funds are better than FlexiCap funds, or you should replace your FlexiCap with a focused fund? More generally, is a focused portfolio better than diversified one? Let's try to answer these questions in the conclusion. Focus funds have done better than FlexiCap funds and the Nifty 500 in terms of average 3-year rolling returns and the volatility of those returns. But in terms of annual returns and downside protection, they don't impress much. Now, this suggests that over the medium term, the volatility of a focused fund portfolio tends to dampen and its returns potential improves. This makes them a good option to explore, especially as a substitute for FlexiCap funds. In the past, we have done videos on other fund categories that can act as a substitute for FlexiCap funds. However, this doesn't automatically mean you must replace your FlexiCap fund with a focused fund. Notably, the difference between the returns and volatility of focused funds and diversified funds isn't much either. In terms of average 3-year rolling returns, the difference is just 0.86 percentage points, And in terms of volatility of those rolling returns, it's 0.63 standard deviation points. So do assess your fund's individual performance before taking a call. And as far as the hypothesis that focused portfolios are more rewarding and riskier too is concerned, the case of focus versus flexicap funds seems to disapprove it, and rightly so. After all, portfolio management abilities matter more than the portfolio size in determining a portfolio's risk-return grade. That's why on the one hand, we have Warren Buffett, who got success by holding just a handful of stocks, and on the other hand, there is Peter Lynch, who once held more than 1400 stocks in his fund, but that didn't stop him from becoming an investment icon too. And with this, we have come to the end of the video. I hope you found this video useful, and if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.